We're speaking now with Shantanu Roy, who's the CMD of BEML. Mr. Roy, thank you so much for your time here on NDTV Profit. Let's start from the latest order of 136 crores from Defence Ministry for high mobility vehicles and battlefield surveillance systems. Clearly, I mean, of course, there are limited details that can be given on the kind of order. But I want to get a sense from you on whether Q3, Q4 become key for the order flows to begin. Is this just the start of the order win flow that you expect to see, like we're seeing in some other companies in this space?
Good morning, and thank you for having me with you. Yes, the Q3, Q4 should be much better in terms of the order flow. The first 6 months, the order inflow was around 2,000 crore, but in this particular quarter, the third quarter, we already have received orders more than 4,000 crores. So currently, the order book of BEML stands at around 16,000 crore, and I can see a further inflow of around 4,000 to 5,000 crore in the coming 3 months up to the end of this financial year. So definitely, the third and fourth quarter are better in terms of the order flow.
This is important. And the 4,000 to 5,000 crores coming in the next quarter, or you're saying before the financial year? And are these largely MOD, Ministry of Defence?
It's a mix. It's a mix of MOD. It's a mix of rail and metro, and more from the mining, because mining orders start picking up from the third quarter, and that is what has happened. The third quarter, we have received some good orders, and in the next quarter also, we expect to receive some very good orders in mining.
You know, you talked about railways as well, and I think the big one is the bullet train from Mumbai. Comes back in focus after the Maharashtra elections. In fact, Finance Minister Nirmala Sitharaman, in her first speech after the election results recently, talked about how the bullet train is now back on track and would have been up and running if not for the political situation. Can you give us any kind of picture on timelines from your end, what this huge infra project is going to look like from your perspective?
You see, the bullet train project for us is basically a development, right? We have to develop 2 proto rakes or 2 proto trains of the bullet train, and that is in collaboration with NHSRCL, ICF, and the Railway Board. It's a joint effort. It's a collaborative effort, and the best thing is that it will be done in the country for the first time. And we are looking at it from the perspective of capability development, as well as, the most important thing is that the intellectual property for this remains in the country, remains within the country. So that's the most important thing. And the timeline is a very ambitious timeline of December 2026, when we have to roll out the first train to undergo trials and all. So we are on it, and definitely with the joint effort and all India effort, basically, we'll be able to do that.
Mr. Roy, good morning. Niraj here. I heard you say that the mining and construction segment will probably deliver maybe the highest order flow. The belief here is that on defense side, a lot of orders will get bunched up in Q4. That's what a certain section of the market seems to believe. Will it be not the case that defense orders will perk up, or that you will see a higher flow of mining even as defense orders pick up?
Hi, Niraj. As I said, it will be a mix. It will be
Agreed.
A bunch of orders from defense. It will be a bunch of orders from the rail metro and from mining also. But traditionally, mining orders, they pick up in the third and fourth quarter. So that's the reason I said that, there will be a mix, maybe 30% each, or maybe 40% mining, 30% defense, 20% rail. This year, if we look at 6,000 crore order inflow, 67% has come from the rail and metro sector. So I think it's now time for the other verticals to deliver. And as far as the contribution is concerned, if you look at our past 2 years' performance, 22-23, mining contributed 50% to the top line, rail and metro contributed 27% to the top line, and defense contributed 23%. Whereas in the last financial year, mining went down to 43%, rail did phenomenally well at 38%, and defense went down a little bit to 19%. That was mainly because of the indigenization challenges. But this year, the most surprising and wonderful thing is that mining is going to contribute to the majority. My expectation is mining will contribute around 55% to the top line of BML for the financial year ending for FY25. So, but in the long run, rail and metro and defense, these orders and the execution, the sales realization is going to pick up. And I've always maintained that, defense and rail and metro, they have a gestation period. For example, a metro project has a gestation period of at least 2 years, 100 weeks, 104 weeks when the first proto comes out. And the real realization starts happening only after that. So
Right.
that's the reason probably from FY26 and FY27, we'll see a jump, a quantum jump in the sales for rail and metro and for defense as well.
Wow. Okay. So, Mr. Roy, so therefore, when you've spoken about possibly doubling your revenues over 3 years from FY24 to 27, while FY25 mining does the lion's share of execution, over a 3-year period, does it become even Stevens between 3 segments? And therefore, is that kind of contribution change to the overall mix margin accretive as a whole, or is it margin dilutive?
So first, let me talk about the contribution. So in the coming 3 years, the contribution, my expectation is that rail and metro and defense put together will be contributing around 65% to the top line, and 30-35% will still keep coming from mining. And in absolute terms, all these 3 will grow. So again, it's an indicator of where the thrust is. At the same time, as far as the margins are concerned, you see which of the verticals add to which of the product mix add to the margins. So margins, as far as margins are concerned, it depends on the market, it depends on the product mix. And now, if it's a high-end mining equipment, if it's commuter rail, if it's defense, if it's sustenance, after-sales services and parts, definitely it's a positive impact on the margin. And that is what is going to happen.
It's also Samina joining in. Just before we continue talking about this, what I want to get a sense from you on is your book-to-bill ratio, which has actually improved to 2.9% in FY24. What is the ratio you're targeting for FY25 to close FY25 at, and how does that align with what you've just said to us, where you're looking to double your top line over the next 3 years? So where can we see a book-to-bill ratio move to?
You see, it's very difficult for me to, comment on what will be the book-to-bill ratio in the coming 3 to 4 years, but I can give you a sense of it. As I said, this year we are already sitting at an order book of around 16,000 crore, and with a further order inflow of around 4 to 5,000 crore in the coming 3 months, we will reach somewhere around 20,000, 21,000 crore. But at the same time, we'll be executing also. And my expectation is that we end the year with an order book of somewhere between 17,000 to 18,000 crore, and the top line growing by 20% as compared to last year. So I think that should give a sense of where the book-to-bill ratio is going up. And if we are able to double the top line in the coming 3 years, we should be looking at an order book of at least 30,000 crore, 35,000 crore. That should be the aim. So if we have a healthy order book, then definitely we can aspire to improve our top line. And whatever is the improvement in the top line, it adds to the improvement in the bottom line as well.
Any pending bids for FY24, FY25 that could significantly move the needle on the order book, Mr. Roy? And also a quick word on margins, because while margins have improved to 8.5%, I'm assuming the second half of the year will come with higher R&D cost, and of course increase in wages. That would move margins back to 6.5, 7, or you think you will maintain 8.5?
You see, if we look at the wages are exactly half of what we did, what we spent last year. So last year we ended the year with the wage cost at around 20% of the top line. So I expect that the wage cost should remain at that level, or maybe a little bit lower. If we improve the top line by 20%, then definitely it is going to come down. It should be around 19%. In the coming 2 to 3 years, the wage cost should be at a level of around 17% of the top line. Looking at the margins, 3 years back, we were having an EBITDA of around 7%. It has grown to 12% in FY24. This year, my guidance remains the same. It will be 100 basis point growth. And in the coming 2 to 3 years, the EBITDA should grow by another 200 to 300 basis points.
Just one final question. In lot of things that you're doing, because I heard you say that it depends on the nature of the orders as well. Company or analysts who have maybe met you or look at you in detail say that your capabilities in for example, defense are going up, and I believe the domain expertise and capabilities would probably lead to higher margin defense orders, not just in number as well. So therefore, I'm just trying to understand if the mix changes to what you said it does, 35% mining and then 65 between the rest of the two. Let's say in FY27, if you are at that mix, would the cumulative margins be higher in FY27 than what they are right now? Maybe you said it, but I didn't get it clearly. So could you tell us, please?
Yes, definitely the cumulative margins will be much higher.
Much higher.
That's why I said the EBITDA should be around 16%, 17% in FY27.
Okay.
Because of the defense orders, because of the commuter rail, because of the high-end mining equipment, because of the sustenance. You see, aftermarket sales and spare parts, they contribute in huge numbers to the margins. And of course, we are forgetting exports. So exports also contribute hugely to the margin. So we expect to do very well in exports in the coming 2 to 3 years. So all this will add to the margin.
Very lastly, how is your working capital looking like right now? Because from everything that you've said and the significant lumpy orders that you will have to execute and deliver soon, will there be any pressure on cash flow? And also, with all that R&D expenses lined up, would you be looking to raise funds, or would that be with internal accruals?
We have not planned to raise any funds from outside. In fact, we don't have any debt at present. But yes, for the capex, we are definitely looking at funding our capex through debt. As far as the working capital is concerned, yes, definitely we are closely looking at it, and our aim is to bring down the working capital by 30% in the current financial year, and maybe further 20 odd percent in the next year. Because I believe, as a thumb rule, the turnover of the company should be around five times the working capital. So that is where we want to be, and that is where we want to go. And for that, it's very important that we keep a very close check on our cash flow, the cash inflows. And, the mining vertical helps us because of the low turnaround time. And it helps us in improving our cash flows. It helps us in improving our margins as well, if it is high-end mining equipment, and especially if it is exports of high-end mining equipment.
Got it. Mr. Roy, sorry, just a quick 10-second answer. You were at 11% EBITDA in March 24. Trailing 12 months, also 11%. Did I hear you correctly? From 11%, you'll move to 16 to 17% in 3 years?
We were at 11.97% in March 24.
Okay.
This year, we should move to around 12.97, 13%. In the coming 3 years, we should move to around 15% to 16%.
Okay. Just wanted to get that clarity. Great. Well, wishing you all the best for that and more, Mr. Roy. Keep up the good work, and thanks for speaking to us today.
Thank you very much.
That's BEML, and a confident BEML, guys. That's, major expansion in defense order inflows, expansion of margins, doubling of revenues from FY24 to 27. Expensive stock, but saying all the right things.